I'm gonna start.
All right, guys. So a lot of you have questions about how these contracts work, how they make money. Some of you guys always ask, how come the price is going up and the contract value goes down and vice versa. Some people want to wonder how come the price is going down, but they actually still make money or they don't lose any money. So we're gonna go over all those things right now, and hopefully you guys understand. All right. So do you have a chart actually in Discord? We can just that chart that's in the study charts. I think
The delta.
Yeah, like delta, gamma, all that stuff.
I got you.
Yeah. All right, cool. All right, so when we get so whenever we look at the any options contract, guys, we're looking at four main things, right? We're looking at delta, theta, gamma, and vega, right? Rho is about interest rates, and that doesn't really apply to short-term options traders, and definitely doesn't apply now that the interest rates are actually being kept to zero. So Rho is pretty much useless for us as short-term day traders. So we want to look at the four main Greeks, which is delta, theta, gamma, and vega, right? So all delta is, it just tells you roughly how much money you're going to make for every dollar the price of your share goes up of the contract you're trading. So for example, you want to go back to the contracts, right? So we're looking at beyond right now. And if you want to look at pick a strike, the 125 strike, right? So you guys look on the left-hand side. You guys can see that it has a delta of 0.5. So that means right now that what let's say beyond is 124.74, the last price, right? So if beyond hits 125.74, then this contract should go from what's the contract price? Sorry, 3.85. Yeah, it should go from 3.85 up to 4.35, right? Because that is, you have a 0.5 delta, which represents $50 in value. So all Delta is saying right now is that for every dollar this thing goes up, you're going to gain $50 per contract, roughly, right? If no other factors are considered. Is that good so far, guys? Just give me a thumbs up because I don't want to have any confusion.
All good.
All good?
Yep.
All right, cool.
All good.
Now, if you guys want to look at the next Greek we look at usually is theta, right? So as depicted in the chart, theta is time decay. There's a time decay in your option. And theta works the opposite, right? So if you have that same contract, that 125 strike for beyond, you see how it says we have a theta of minus 0.34. So all that's saying is that every day that goes by, you should expect to lose about $34 in value for your contract, right? So right now, this contract is going to open at least $34 lower. If Beyond opens at the exact same price right now, this contract will actually open $34 lower, right? Because this is just time decay, and all it's telling you is that the closer you get to expiration, the less of a chance you have to actually be in the money or hit your strike price, right? That's all Theta is doing, right? So this contract should open right now. If Beyond gapped up $1 tomorrow, so let's say we open at 125.74 instead of 124.74, then we should have a net gain of $16, right? Because we have 0.5 delta, which adds $50 to our contract, and then our Theta will take away $34 of value, right? So at the bell, if Beyond opens a bit higher, we're going to get $16 per contract, right? And of course, Theta will increase every single day because as you get closer to expiration, then these contracts will lose value very quickly. All right, let's go back to the chart for a second. That the PowerPoint thing. Yeah. All right, so the next Greek we want to look at is gamma. Right. All right, so all gamma is delta's rate of change. So you can think of it as delta of delta, right? So delta basically shows you how much value your contract will gain depending on the price of the shares of whatever contract you're trading for, right? So like I said before, if you have 0.5 delta, that means you will get $50 per contract. Now, what Gamma does is Gamma will add on to Delta, right? So you can think of Gamma as like a momentum indicator. If you have a high Gamma in your contract, that actually means that for every dollar that this goes up, Gamma is going to add to Delta, right? So let's say Beyond gains $3 right now. So right now we're at 124.74 again. If Beyond goes up $1, that means that our new Delta is going to be 0.54 because we have a Gamma of 0.04. And once the share price moves up $1, again, Gamma is going to add on to Delta, right? So instead of our next share dollar adding $50 in value, we're going to add $54 in value, right? Then we're going to add $58 in value, right? So it's not going to be 50 plus 50 plus 50. It's going to be 50 plus 54 plus 58, right? And Gamma goes to 0.5 because there's more momentum, then it's going to be plus 63 now, right? That's all Gamma does. So if you pick contracts with high Gamma, you will actually, those will end up being better contracts, right? Because you are going to make more money on those contracts more quickly, especially if you go up in price at a rapid rate. So for example, on Thursday, guys, when Zoom ran from like 399 to 414 in about 5 minutes, somewhere in that time, the Gamma started to ramp up pretty quickly. And that's why some contracts went from like $280 up to $1,300 in a matter of 15 minutes, right? Because Gamma was so high at the time. And even if it lost $1, it wouldn't have been that significant unless the drop was very, very sudden, which it actually ended up falling back down to 404 in about 5 minutes thereafter. But that's besides the point. With Gamma, you just want to pick higher Gamma contracts because you will gain more money and lose less money if you were right, right?
Yeah, yo, Costa, quick question. So I'm looking at Thinkorswim on my phone, right? And it's showing, like, I'm looking at the Delta Gamma, but it's not showing me, like, the way it's showing here, like, at 0.50. It's, like, 0.5048. Like, is there a way to just get it where it's just showing the numbers even like that? Or round numbers like that, I mean?
I have to look into it. I don't think you can.
I got you. Because, like, on my Gamma, sorry, on my Delta, it's 0.5021.
You're looking at
0.50.
you're looking at Beyond.
Yeah, Beyond on the phone though.
Let me check.
The 125 strike showing 0.5021, and then on
Yeah, it's just 4 decimals. It's just it's accurate. It's just showing 4 decimals. This one's showing you 2.
Gotcha. I'm saying, is there a way to change it just to show 2 decimals on the phone, or is it?
I think it's automatically like that.
Gotcha. All right, sounds good.
Cool. All right. What's the next one?
So, sorry, I was on mute. I just wanted to be clear on one thing real quick before you move forward on this.
Sure. Yeah.
Contract, the better contract, I should say, is the higher Delta and Gamma corresponding with each other, correct?
Yes and no. It's not that clear cut because Delta is always going to be higher the further in the money you are. Just because if you're further in the money, then it's going to be a lot more valuable once you're there. But if you're further out the money, then your contract won't gain value as quickly unless you start getting to that strike price pretty quickly. So if you look on the call side for Beyond, you see how the closer in the money we are, we actually have a higher Delta every time.
Right.
Yeah, so it's not necessarily a better contract, right? Because if you pick a super high Delta contract, you're most likely going to be paying a huge premium, right? So
and it seems the Gamma remains pretty consistent for 0.04.
Right. So for that reason, my favorite contract here is going to be the 130s, right? Reason is we have a 0.4 Gamma, so it's a little higher than the 131, and we also have Delta. The Delta difference, it's only, if you look at the 129 versus the 130, it's only like a $3 difference. But like I'm paying $27 less for the contract if I buy at the ask. So it's not. So I pick the 130s, right? Because I think it's pretty reasonable that Beyond can run $5 or even like $2 or $3 upwards in the next 5 days, right? And you'd end up making a pretty good amount from that contract.
And also because you have more open interest on this contract, you can get rid of that contract easier.
That too. Yeah, we have to go over open interest, and volume, and implied volatility. All right. Let's look at Vega. Okay. Very simple. Vega, it says it right there. It represents the option contract sensitivity to implied volatility, right? So for those of you who don't know, implied volatility is the expected move of a stock after an event, right? So this event can be anything. It can be an FDA conference. So if you guys are trading penny stocks and you have you know that it's in lineup for a new drug to be released or for FDA approval, then the implied volatility is going to be off the charts, right? So I consider a high implied volatility anything over 100%. Average implied volatility is going to be anywhere from like 40 to 80%. You know, it'll vary depending on for many factors like market conditions. You know, if VIX is higher, you're going to have a higher implied volatility on the SPY contracts, for example. And when a company has earnings, that's also another. If you have earnings, then that's going to be another. That's another catalyst for high implied volatility. Sorry, I saw a question in the chat. Let's see. You're saying if you have no money issue and you're sure about a contract going up, is it better to buy contracts in the money? Yes and no. You're not. Okay, here's the thing. Even though buying contracts in the money, it's going to be expensive, first of all, but it's not really going to be worth it because since these contracts are going to expire anyway, they're going to expire with value anyway. It's implied that these contracts will expire with value, right? So if you buy these in the money contracts, you know, you're not going to get that much of a move. Like I know your delta is higher, but Theta will still eat away at the contract, right? And these things are priced in a way where you're not really going to make that much money, if that makes sense, right? Because remember, the whole point of an options contract is to exercise it, right? So it could be a situation where you're going to be paying $835 to make maybe $80, and also your gamma is going to be decreasing, right? The further in the money you go, the less your gamma increases. So yeah, you don't necessarily want to buy far in the money contracts because they won't actually be worth as much more, right? You have a much better return on investment if you buy near to the money contracts, something like the 125, 126, or a bit further out the money. I just don't think deep in the money contracts make as much money from experience. The other thing is, deep in the money contracts tend to have less volume and open interest. So if you just buy those contracts, you're probably not going to be able to sell them, right? Because people are going to be holding them and not really letting go of it. So for example, that 118 strike has a volume of 15, right? So if you try to buy more contracts, you might actually end up not being able to sell it, which would be pretty unfortunate for such a high investment. And then you'd be stuck either exercising it or losing all the money, which would mean you need to buy 100 shares of Beyond at that strike price, which is nice, but I'm not sure if you want to spend 11 grand. It's up to you. Yeah, no problem, man. All right, I was going over Vega, right? Implied volatility, right? So earnings, medical conferences, as presidential executive action, anything that's significant to the company or sector will jack up the implied volatility of the contracts, right? And as implied volatility increases, the value of your contract will also increase, right? Which is good if you already have the contract, right? So if you have, if you guys notice, sometimes, for example, all right, so NEO, all these EV companies started running up for no reason. If you guys watch NEO, those contracts probably had like maybe like a 150 implied volatility, which is already pretty high. But then as the entire sector started to run, the implied volatility actually got jacked up to over 200%, right? So we look at 237.98%, which is good for people who are holding the contracts, right? Because even if their contracts didn't really move as much, they're not going to lose really any money if the price even tanks a little bit, right? And we saw this actually on I want to say Friday morning. You probably can't see it now because they all updated in the afternoon. But I saw some of the put contracts have an implied volatility of over 300%, which was pretty cool because if you had bought NEO puts when NEO was trading at $50 and then it ran $3 up to 53, those put contracts barely lost any value. I think I bought one for fun, and I think the biggest loss I had was maybe like a 6% loss. But on a company that moves 10%, almost 10% upwards, holding put contracts, that would be grounds for it to be worthless, right? And then when NEO started moving down, that gamma started getting jacked up, right? And anyone with NEO puts could have made an easy 500% on the way down had you follow those charts. So implied volatility is a good thing if you can catch the contracts before the implied volatility gets increased, right? Implied volatility will always jack up the prices of the contract. And then that's where Vega comes in, right? So Vega is a Greek that we use to calculate pretty much how the option is going to respond to implied volatility, right? So I'll kind of go over that calculation, and hopefully this will answer the question of why a stock will move and you will actually still lose money even though it moves in the desired direction, right? So let's take, let's see, we can pick any contract. Let's pick a random stock, man. I'm sick of Beyond. Apple. It's turtle of a stock, right? All right. So actually, who was earnings? Let's see who was earnings this week because that's actually easier.
Try Amazon. I think that had high implied volatility.
Amazon always has high implied volatility.
I'll do NEO.
Yeah. All right. NEO has earnings. All right, cool. All right. So if you guys are looking, here's how you kind of calculate how much money you're going to make or lose on your contract, right? Remember, most options are designed to expire worthless, right? So as options traders, we need to get in and out in that 10% period, like because 90% of options will expire worthless. So we want to get in that period. We want to get in and get out in that short period of time where the options are worth something, right? So if you guys look at these NEO contracts, that 44 strike, we have an implied volatility of 237%, right? Let's call it 238%, right? And then if you go and check out like November 20th, sorry, the 27th, those contracts, what's the IV on those, right? It's still jacked. All right, check like a January 15th. I want to see something for a bit. January or anything, right? Jan 15th. All right, that's still pretty bad, but I can kind of show you guys how you make this calculation, right? So there's a concept in options trading that we call implied volatility crush or IV crush, and that basically will show you how much the contract price is going to settle after earnings, right? Because whenever you have an implied volatility that's pretty high, remember that investors are betting on a huge price move, right? So if NEO right now trading at 44.56, if it has earnings tomorrow, I mean, I know it doesn't, but let's say we had earnings like tomorrow morning and NEO runs to $48, every single contract here is going to be worthless and it will lose money. Why? Because according to the implied volatility, this stock did not move nearly enough for you to make money, right? Because remember, this is an example of the thing being priced in because there's all that money that was generated as the IV got jacked up. So if it doesn't move enough, then these contracts will actually be worthless, right? And here's how you kind of calculate how much money you're going to lose the day following the event, right? So the first thing you want to do is you want to look at your Vega number. So on the November 20th contract, we have a Vega of 0.02. So we're going to take that number, right? And we're going to multiply it to the difference of our implied volatility on that contract minus the average implied volatility, right? So you guys can check the average implied volatility of any stock by just looking at any other week, right? So look at the week before, look at the week after. That's going to be a pretty good range. So for NEO, it's still pretty high because I think people are really betting long on this contract. But just for the sake of this lesson, I'm going to look at the 44 strike contract for what's the implied volatility. There, that's much lower. Okay. We'll just use the January 15th one just for the lesson, right? So if you guys are looking at the implied volatility of the same 44 strike contract, we have an average implied volatility of 145.29, right? That's kind of like where the implied volatility likes to sit, right? So what you do is you would take 237, which is the implied volatility of our weekly contracts, and we're going to subtract 145 from it. And that should give us, this is in my head, I think 92, 93, 92, 69.
92.69, yeah.
Yeah, nice. Yeah, cool. So you get 92, 92.69, right? Then you're going to take that and you're going to multiply it by your Vega number, which is representing $2, right? So right off the bat, this contract is going to lose 92 times 2 is 184. So this contract should lose $184 in value after the event, no matter what happens, right? If it flies or whatever, right? No matter what happens, you're going to lose that much money, right? Then if you look at your theta, you have a theta of 0.46. So now you're going to lose another $46 in your contracts. So right off the bat, if NEO reports earnings tomorrow, that 44 strike contract that is listed as 5.2 or $520, right now you are only going to make $290. You've already lost $230 in value. So right off the bat, you're going to be down 230, and there's no way to avoid that, right?
Hey, can I ask a question related to that?
Yeah, go for it.
So, like you're saying the day after the event, or is it immediately following the event? So like, let's say you pick up, let's say you bought calls right before the bell, right? And obviously like they report earnings, and let's say it moves $1, which is not enough to do anything based on what, you said you need to move a ton. So you're like, okay, I want to sell. Like at that point, have you already lost all that money you're talking about, or is it still going to be the next day?
No, it's immediate. Like it's the day, it's whenever it happens. So if you buy calls right before the bell on Monday evening, and NEO reports on Tuesday, once the market opens, those contracts will be adjusted, and that money is gone.
But you could sell in that 15 minutes following. I guess is my point. So like, let's say you bought NEO calls on Tuesday right before the bell.
You can only sell 50 minutes on S&P, not regular stocks.
Yeah, you can't buy anything before the bell. Yeah, you can't buy those contracts before the bell. Yeah, options are only traded during market hours with a few exceptions.
No. I'm saying like you would buy the options, like let's say at 350. Then the bell happens and they spike from earnings, and then you still have 15 minutes to sell your contract.
No,
you don't.
That's only on the ETFs.
Yeah, you can't sell your contract. You don't have that. Yeah, like I said, it's only a few tickers can be traded, and those tickers never have a jacked IV ever, so that wouldn't apply to this, because ETFs don't have implied volatility unless something affects the entire sector, and those ETFs aren't even on that list. Yeah, you see the low IV on SPY?
19%.
This is the average implied volatility on SPY, right? So there's going to be no IV crush in SPY contracts, right? You're going to focus a lot more on delta, gamma, and theta. Yeah.
Learn something.
Yeah, I hope that makes sense. Yeah, this is a bad example, honestly. Just because NEO is going to have a high IV. I mean, one example I did have was Datadog, but I don't think. I mean, obviously that's gone already. Yeah. Like for example, I think the theta at the time was like $80. I had like an $80 theta, and the Vega was like 0.4. So the average volatility.
Check Home Depot. I think they have earnings. They might have a decent volatility.
All right, let's see. Home Depot shouldn't have a high IV actually. Yeah, reason is the IV is actually the same because people are not expecting a big move on Home Depot. This is more one of those stocks where people are just going to watch it go up until the end of time. It's not a huge deal. Like people do think HG is going to beat earnings and keep rising at a steady rate. I think it's earnings is just confirmation. Yes, this is a great example. JD, right? So if you bought let's look at that 94 strike contract, right? So another example, our Vega is 0.05. The average IV, if you look at both contracts, you're looking at the 94, 95 strike. Pick the 95, just there's no 94. Yeah. So if you look at the 95, you can check the week after actually. Check the 27th. That's a better representation. Yeah, the 20th versus 27th. I mean, like the 20th versus 27th.
Oh, my bad.
Yeah, you good. All right, that's better. Yeah, so we look at the 95 strike, right? We have a Vega of 0.05. We have a Theta of 0.39, negative 0.39. Our implied volatility is 93.92, right? So look at the difference. 93 minus what, 71? I think that's 22, right? Roughly 22. So if you multiply that by 0.05 Vega, then we have $110 lost in value just after earnings, no matter what, right? And then we're going to lose another 39 bucks for Theta. So right off the bat, our $370 investment has already lost $149 in value, right? Now, this is a pretty good contract, right? Because if JD moves up even, a couple dollars, then this is going to be great, right? Delta of 0.46, right? So if JD moves even $4, you've already wiped out your losses, right? Because with a delta of 0.46, if we're going to ignore gamma, then we can just say that 46 times 4 is, I think, almost 184, I think. So if it's 184, we've already wiped out the losses from IV Crush, right? But if you do take into account those losses, if JD moves up $4, you've actually only made $35, right? So your $370 investment turns into, what is that? To do a lot of mental math. 370 plus 35 is what, 405, I think, right?
Yeah.
So your $370 investment will turn into a $35 profit, which is about a 10% gain. But with JD trading at 92.08 and moving up $4, that's about a 5 or 6% move, right? So a 6% move in the stock would usually warrant a lot bigger than a 10% gain in options contracts. But if you take IV Crush into account, then JD really needs to jump at least 5% for you to make any money. And if JD beats earnings and goes up 3%, you guys will actually lose money. Does that kind of make sense, guys? I know I'm doing a lot of talking, but I want to make sure you guys really grasp this concept, right?
Yep, I got it.
You got to use basic mathematics to figure out why some contracts might not be worth it, right? Because remember, these guys don't want you to win, right? I mean, everyone knows that people are going to buy contracts before earnings, right? So they jack up the prices, and they really want you get you to put your money where your mouth is. Is JD going to beat earnings? Almost definitely, yes. Is it going to warrant a 5 or 6% move in the stock price? I don't know. We never know, right? So
They're expecting a $10 move.
$10 move. Yeah, I've seen expectations for a $10 move on stock and it's moved like 2% before. So we'll see what happens. It's all about the investors, right? It's all about the shareholders. We have no control over this. Right. The best way to avoid IV Crush is to not get caught up in it, right? What you do, if you still believe that JD is going to run, let it report earnings and then you buy that 95 strike contract, right? Because if it only moves like $1 or $2, everyone who held the contracts is going to get IV crushed, and these contracts are going to be like half price off, right? And you still have the rest of the week for it to run. If a stock does well on earnings and then dumps or doesn't really move, chances are it's going to rip the next day, especially in a bull market like we're in right now. So.
All right, I'm trying to just write this down, but just tell me one more time. So compare the current week with the further week on the implied volatility. Take
the difference, right? And then you're going to multiply that by your Vega, right?
Okay.
Yeah, it's a lot to consider. Yeah, I know it's a lot to process. This took me months to really get it down. But yeah. So take the difference between your implied volatility. And when I say the next week, it doesn't have to be the next week. Just kind of scan different weeks and try and see like where the average IV is. Right. I mean, obviously it will go down as you go further in time, but not that much. Like there's gonna be like a base level somewhere. So it looks like 52 is kind of that sweet spot. Even the week after might still have a high IV. Especially if I don't know. It's just different factors. Just try and find like an average number, and that can kind of put you in the ballpark about how much money you expect to make if the stock, how much the stock needs to move if you want to expect to make any money at all. Right.
All right, what's like an average IV for a stock?
If you got background noise, please mute your mic. But for average IV for stock, I would say it's anywhere between like 40 and 70, maybe like 20 and 70. There's not really, I don't really have an average number, but I know anything over 100 usually means that something is coming. Like anything over like 80, and anything over 200 means that something big is expected. Not necessarily coming, but it's just big expected, right? So the worst case scenario for any investor right now who is not holding shares is that NEO reports earnings and the stock does not budge, because that will obliterate all these contracts, because that IV would go way down the day after and all that premium is gone because it would be priced in. So that's why
Would that be a situation where you would buy the actual, just an ETF of it, the equity in it and ride it out?
Yeah, I really think it's much better to buy equity in NEO right now. I think it's much safer than trying to predict where it's going to go. Like NEO has dumped 17% and then ended down 6% on Friday. Like it can do anything right now. There's short sellers attacking it. There's going to be a short squeeze again. We don't know. If NEO starts to run tomorrow, you guys can probably catch these call contracts in the morning, only because now everyone has started trying to short it. So once you see the price going up too quickly, there's going to be a short squeeze, and then bad things will happen to the short sellers at least. So yeah, I think equity is safer, honestly. If you really believe in the company, do some research, all that stuff, all that good stuff. All right, and the last thing I want to go over for these Greeks is, it's not really a Greek, but we have volume and open interest. Very simply put, volume is the number of hands that these contracts have exchanged, right? So with a volume of if you have a volume of 15 grand, all it means is that this contract has left different accounts and gone to another account 15,200 times. That's it. Open interest is the number of contract holders. That's all. So, yeah.
So when you pick a contract, you want to pick like contracts that have high open interest, obviously, right? With volume.
Yeah. So you want to pick. Okay. Well, it's there's two sides of it, right? It's double-edged sword. You want to pick. So basically, what you want to do is you always want to get contracts before everybody wants them. But at the same time, if you do pick a contract with higher open interest, you'll lose money a lot less faster, right? Because that means that more people want the contract in general. So if the price drops, you're not going to see your premium drop as much if you have a higher open interest contract, which is why we often will pick like a 130 strike on contract instead of like a 129. People psychologically like whole numbers like 130 or 125 rather than like a 129 or like 117 call on something. So you'll tend to see a higher open interest on those. And also, the highest open interest contracts tend to be the ones that are very close in the money or not too far, like pretty much near to the money. If you see very high open interest on a contract super far out the money, you want to pay attention, especially if you have a gap. So let's like a gap meaning, for example, right, if we're looking at this NEO still, so if you guys see the 50 strike contract has an open interest of 22 grand, and then the 66 strike contract has an open interest of 0, right? If all of a sudden you start seeing the open interest on like the 70 strike contract, for example, go up to like 10,000, then you almost want to buy into that immediately, because that means that somebody knows something. There's no reason why someone's going to buy a contract like 40% out the money. This is not going to happen, but like if you're looking, especially like on pharmaceutical companies, and you see all these contracts with no open interest, and then all of a sudden you see one contract with like 20 grand open interest, like something's coming and somebody knows something, right? That's how all these traders get to catch, like these moves and these like 14,000% gains sometimes just by looking at open interest alone. And then with volume, I did say it was double-edged sword, right? So if you look at volume, volume over open interest is what every program uses to kind of calculate unusual options activity. So whenever you look at something like bar chart or any flow scanner, they will be picking contracts that have a very high volume over open interest, right? And what this signals is that this contract has exchanged a lot of hands, but only a few people are holding it, right? So generally people don't want contracts that nobody else wants. So usually any contracts with high volume over open interest means that somebody knows something is about to happen, right? So for example, if you guys caught PDD the other day, I was scanning all of his contracts, and then all of a sudden I saw it had like ridiculous volume over open interest, right? It's probably not there anymore. Check the 170 strike on these. It might still be there. You guys might see what I'm talking about. All right, that one for example, right? Yeah, the 170 strike. You see how it has a 12,000 over 467, right? That's a very, very high volume over open interest. You know, if I do 12,000 divided by 500, just at the ballpark, that should be somewhere 23, 24, I think. So that's like a 24 volume over OI. And that's a very, very important metric you guys want to look at, right? Because most programs consider any number greater than 5 to be very unusual. So if we have volume over open interest of 24, that's pretty scary. And that means that something is about to happen. And I will tell you, this contract is almost guaranteed to go up, right? Just because of those numbers alone. So when I had you guys play PDD the other day, I waited until it found the bottom, and then I saw a contract with like a 1900 volume over open interest, and then I alerted it, right? And I didn't know why it was going to bounce there. I didn't know why it was going to go up, but looking at the charts, I did see it was oversold, and these call contracts went in with a 1900 volume over open interest, which is like 300 times the normal unusual options activity. So the second we bought those contracts, they were up like almost 80% within 10 minutes, right? So those are kind of the things you guys want to pay attention to, right? Always look for contracts that have a high volume over OI. And it's almost always going to be the ones that have that are pretty far out the money, right? It means that someone's expecting a very big move on this. Even looking at the 165 strike, you guys see how yeah, we have 10,000 over 74. That's pretty scary, right? So that means that investors are not expecting the stock to go down at any time. That's like 135 volume over OI. So that's a very, very important metric you guys want to look at in picking options contracts, right? If you guys just pay attention to this and you guys start trading using these tips, you're going to see your trading improve a lot.
1 minute less.
Got 1 minute left. All right. Yeah, we can just stop this. Let's see if you guys. I'll ask in the chat if you guys want to go over a couple more things. Everyone, just go to the priority mentorship chat for a bit, and just chat with me a bit. Let's see if you guys have any other questions.